Hey traders, Raghee here, and in this recap video we're going to take a look at how the markets responded to the FOMC, what happened, and what happens now, okay? So a couple things. First of all, the overall trend, as I've been talking about for the better part of 4 months now, is going to be down. In fact, the Russell is already in bearish territory. That means we've already seen the Russell off the 2018 highs by that magical 20%. I just call it a crash, right? If we moved off the highs by 20%, that is just a crash to me, but more gently spoken, it's the bearish territory. So Russell is there, and a lot of people feel that the Russell is sort of the harbinger of more weakness to come. Well, I believe that. I think that we are going to see overall lower lows in the stock market. So why the play that I had on the FOMC? So I've been, look, when something doesn't go well, I want to absolutely bring it to the forefront, because one of the things that we did two really important things. One, we played this with options, okay? And we bought the calls on a down day, which makes the cost for the options minimal as compared to looking for the calls on an up day. So that's number one. We kept our costs low. Number two, we kept the time generous. We looked for minimum. My rule of thumb is 30 days to expiration. So we kept that 30 days. I want to see kind of 30 days plus. That's kind of where I start looking at the options chain. Do we have about 30 days to expiration? We've been looking at the Jan 18s. All right. So first of all, did the market do what I wanted it to do? Well, funny enough, it did for about the first half of the day. And so this is where I'm going to armchair quarterback myself, and I hope you can learn and benefit from this, because it's not a matter of right and wrong, it's a matter of choices, okay? So let's actually highlight right up. So what you have right here is everything right up to 2 o'clock. So there's an idea called a time-based exit. So you can be based on time, say 2 o'clock, that's a clock, or you can be based on price. Okay, most of the time we base our exits and entries on price, and we want price to move in a certain direction, and we can, take the trade off. But sometimes it's a matter of time. So we had this 2 o'clock deadline, so to speak, when it was widely anticipated that we would get what's known as a dovish hike. In other words, we'd get the 25 basis point hike, and then we would hear a rate statement that would remove key wording like the gradual increases. And actually the press conference would then also reiterate perhaps that the FOMC is going to be incredibly data dependent, and that they are looking at some of the headwinds like the global economic slowdown, that they would acknowledge that the tariff war was taking a toll on business confidence, and that they would acknowledge that inflation is indeed contracting, has been since July, and also that GDP has been sort of flattening, if not even slowing. All right, and those would be ways that they can tell the market, hey, we see what you're worried about, we acknowledge it, and we will act accordingly. They're never going to say we're done hiking rates, but they could have not acknowledged those things, and I think that was really very much what the expectations were. Now, I'm not guessing. The market was heading up since the open. Now, a time-based stop would look at the clock and say, all right, here we are, 2 o'clock. We've climbed up all day. Maybe it's time to go ahead and really, realize a profit. Well, and I'm going to, like I said, I'm going to armchair quarterback myself. That could have been one choice as we, closed in on 24,050, 24,000. Hey, this market's been pretty good to us. If there is an unrealized profit here, let's go ahead and maybe take half or even all off the table. That is an eject button. You're just getting out because of time. And that's a valid way to manage a trade. What I was looking for were all those dovish components that I mentioned. A change in the statement and a very accommodative sounding press conference, citing a lot of the issues that we all know are in the market. And instead, we had a hawkish hike. We had a Fed saying, hey, look, we're not there yet, and the market responded accordingly. So basically, regardless of which we think we might have heard, the market has spoken. They hated the press conference. They didn't get the help they wanted, and the bulls fled the market. Now, let's talk about the position. We still have plenty of time to expiration. So that is one half of it. And it doesn't mean that just because we sold off, the market doesn't decide that, hey, maybe the FOMC is not as hawkish as we fear they may be, right? That's obviously another part of this narrative here. Maybe they're not that hawkish. And, you know, one of the things, and I'll get into more detail about this in the premium video, but one of the things that we could watch really closely, and we were looking at this in real time as the market was moving, this March contract for the Fed Fund futures is pretty much completely discounting, expecting a rate hike in March. This was at approximately 40-something% before 2 p.m. and after, you can see where we are. So this market went from, hey, we're not going to get any hikes. I don't know if I said cuts by accident, but hey, we're not going to get any hikes in 2019 to instantly discounting. Yep, pretty good chance. In fact, we're going to discount that we're going to see a hike in March. And by the way, that percentage is higher than the one we had today when we had the hike. And they're already starting to think about maybe June as well. That's how quickly a press conference and a rate statement can change the mind about the bears. Overall, gang, I'm fine with this because despite the fact that I was looking for kind of an aggressive trade, a quick bounce, you know what I wanted to do after the bounce? I wanted to short. So what we're going to do in the premium video is start looking at all the risk reward ranges, the high to low ranges that I'm going to start looking for on any kind of bounce, whether it's FOMC triggered or not. How are we going to trade gold, crude, bonds, the dollar, the broader index futures, as well as a number of currency pairs. We're going to talk about that in the premium video. In the meanwhile, I don't think this trade is done. I still think we have a little bit of time that we can work with before theta decay becomes an issue. Obviously, we need a rally. Let's see if we're going to get one between now and Christmas. And in the meanwhile, we'll just manage the position that we've got. I'll see you in the next update.